activist investor, the very term strikes fear into the heart of CEOs, boards, everywhere. Tell us, first of all, what kind of a reception you get when you're put through to a CEO and they say it's Paul Singer of Elliott on the kind. Tell us what the reaction is.
Well, that's contrafactual because I'm not the one making that call.
Okay, but
I'm the lurking presence.
It's Elliott on the line. Seriously, the rap on activist investors? You're focused. These are these great corporate boards creating value for the long term. They're investing for the long term. They're thinking about their company and its evolving role in history. And you come along and you're focused on the quarterly earnings, and you're just trying to jack up the share price for the short term. What's wrong with that criticism?
Well, I think that's a very broad brush way of describing what we do. I can't at all speak for activists in general or the activist community. I could just tell you what we do and why we do it and the context of it. A little bit of context is useful. We try to make money all the time. For the first 10 or so years of our firm's existence, and we're close to 40 years old, convertible hedging and other relative value arbitrage was our strategy on low leverage to try not to lose money no matter what. We built activities which were meant to create value and add a manual component as a risk-limiting technique. Distressed investing, where we get on the committees, activist mergers, merger arbitrage, and activist equity investing. And so activist equity investing is a natural evolution for Elliott of trying to make something happen or trying to control our destiny, not just trying to annoy people. We've actually been in the activist equity activity for about 12 years, and we've built a team which now is partially on the East Coast, partially on the West Coast in Silicon Valley. And the idea, and now obviously we have the capital to more or less engage in our projects and get done by ourselves what we need to get done, meaning we don't need partners. We can and do co-invest with people. But the answer to your first question is interesting because we believe in the layered application of the work that we do and the tools that we have to influence corporate policy. What that means is, at this point, with close to $30 billion under capital, what we do get when that phone call comes in from Jesse Cohen, our head of U.S. activism, who's here in the audience somewhere, or somebody else on our team, when that call comes in, at least somebody knows that there's a firm that has the ability to back its assertions and goals, and a team that's done a lot of work. We don't just show up. We may show up in a 13D filing sense, but we spend a lot of time trying to figure situations out, develop our views about which situations are interesting to us, and there's a set of characteristics, which situations are not appropriate or not susceptible or change assertions from the outside.
So tell us how you go about that. That's you say tech team in particular. You're scouring the filings and everything you can find on companies. What are you looking for? What are the characteristics?
Because there are most companies in this space start with a great product. Start meaning after some following, they get some traction. It's a great product, and a typical course is that the great product has what in a lot of cases is a sudden inflection point, where it's growing, and then the growth stops. So the dividing line there, broadly speaking, I mean, there are a lot of versions of this. The dividing line at that point is the companies that make solid transitions to building on their success, adding products and services with adjacencies, proper M&A. Companies like Amazon, the profit may not be there, but the platform that they are building is fantastic. And I don't deign to have an opinion as to how it all will turn out. But there's a company like that that's gone through the gates in their growth. But there are other companies that when that inflection point is something, it's a metaphor, but I mean, when that inflection point happens, they engage in ill-chosen M&A, not proper directions in their capital structure, their leverage.
And that's reflected. I mean, what are the metrics that you said that? Just shareholder return. I mean, how do
shareholder return is one metric, but when you see an inadequate R&D in their core products, when you see M&A that seems more oriented toward, well, we're making $1 billion a year. What are we going to do? We've got to restore the growth. So a lot of it misdeploys engineers, corporate infrastructure towards projects that don't work out. And the luxury that we have, so to speak, is that there's a negative selection here. When we're looking through the universe for interesting situations, undermanaged companies, undermanaged either in their strategy, in their growth of organization, in their R&D, in their M&A. When we see that, we are seeing the ones that don't make the transition. Because when they make the transition, the growth is maintained, the stock price is maintained in most markets or is growing. The valuation is such that you can't see a conceptual or a practical path toward the restoration of a growth path or the augmentation of value. So it sort of leaps off the page. The companies that have done it and are a tough slog, our suggestions are usually not purely structural. Spin this off and everything will be fine.
So give us an example. You've talked about Amazon as an example of a company that, forgive my simple paraphrasing, but is broadly right. Give us examples of companies which have been right for activism. I mean, you can tell us ones that you haven't publicly revealed, although I think you'd probably get into trouble if you did. But tell us, I'm talking about examples of companies that you have moved in on and where you've had a successful outcome in terms of achieving your objectives.
Well, Citrix is a current situation. It's a very interesting company. A tremendous core product in virtualization and has been so for a long time and is still a very sticky and excellent product.
What were they doing wrong?
What they were doing wrong was when the product stopped growing, they didn't have they didn't have the capability or actually didn't execute on proper M&A, proper R&D. They made a series of acquisitions. Now, when a company makes acquisitions, you can't form a solid opinion on the first acquisition that doesn't go well or the second. But when a company does 10 or 15 acquisitions and has a pretty consistent record of not augmenting value but destroying value, you say, well, gee, why are they doing this? In this particular situation, for example, they buy Byte Mobile and burn $450 million, burn it to the ground, basically, in a relatively a short period of time. So, the signs are usually pretty clear. You look at the board of directors, you look at accountability. Citrix is interesting because it's the only one that we actually put one of our people on the board. I mean, frequently, not every time, but frequently we ask for or approach companies with a view that we would like to add to the board or replace members of the board or board seats. This one was the first one where we actually have a person, Jesse Cohen, on the board. And we thought that it was important enough to be able to be part of the situation, part of the search for solutions to what we considered to be a tremendous platform, but poor corporate strategy. We actually were part of the path toward replacing the CEO. The CEO had been there for a very long time, and we did that. And the new CEO has been at the company for 9 months, and we're very excited by the possibility of value and creating more value. For example, in that one, the core product had been actually suffering not just stagnation, but declining revenues. And for the last couple of quarters, and we think we're hopeful that it's sustainable, the revenues in the core product have grown. And so every situation is different. We think that by having an expertise, which has been growing, the team has been growing, the expertise has been growing, the ability to pursue each stage of these things has been growing. What I mean is they're public. You approach a company after you've done a lot of work, maybe taken a position, but you approach a company privately and quietly in almost every case in a discussion. They pick up the phone at this point. The discussion is, here's the work we've done. Let's talk about it. Let's talk about, sometimes we're wrong. Sometimes that discussion, the discussion always goes in all kinds of directions. But it's a layered approach. When something gets cantankerous or worse, we don't go to war. We didn't go to war with Argentina. We had debt, and we tried to...
And you won. So, talking of cantankerous, Samsung, you don't just take on small and mid-sized fish. You take on some whales and some very traditional, mature companies of a very different culture, very from a fundamentally different sort of economic background and culture. Tell us a bit about. And again, you having had your battle with Samsung over the merger of the various Samsung components, you're now back in the struggle with them about splitting the company essentially again. Tell us what you think is wrong with Samsung that you're going to fix.
Well, the first thing that needs to be said is that these were two very different situations.
Sure.
Different. Samsung C&T, roughly a year ago, non-tech, and I call that one passive activism. What that means is we didn't take an activist position. We took a position in securities of Samsung C&T because of our belief of what the company was likely to do in terms of restructuring or possible restructuring that everyone saw was in the cards because of the family dynamics. The founder has been in a hospital, in a coma for a period of time. Everyone knows that there needs to be restructuring. And so we took that position, and then they announced a restructuring, and we thought the restructuring was unfair. In that situation, and so that's what I mean by passive. We were in a situation, and a deal was
kind of done to you, as it were,
yes.
as a shareholder.
And so we fought back.
Yeah.
We lost narrowly, but we think we turned out to be right. But in that situation, the foreign ownership of C&T was about 34%. Samsung Electronics is a very different situation. In that situation, we are and were proactive. Foreign ownership is about 60%, and we are not intending to be adversarial. We actually have made suggestions and have made them as suggestions, not demands, that we think the company either is planning to do or thinking of doing or should be doing given their goals. Suggestions about bringing its capital structure, which we think is under-leveraged and not in accordance with basically global standards of leverage. A lot of excess liquidity on the balance sheet. Board of directors, we think there's an imbalance compared to global standards of executive directors and non-executive directors. We want to expand the board. There are in the outside directors, the independent directors, I believe there are no experts. There are no tech experts, and that's a sign that it's not shareholders, directors setting the strategy and understanding the strategy. It's something different.
The problems they've had with the terrific problems they've had with the Galaxy Note 7, is that in any way a kind of a vindication of your concerns, or is that unfair? Is it just unrelated? Is there something there, or is there something in what you're diagnosing that helped produce the kind of management problems that created that?
First of all, I want to say that Samsung's approach to our approach has been so far constructive, in the same tone as ours.
Have you spoken directly with J.Y.
I have not.
Scion,
I have not. I don't think my team actually has. But our involvement in Samsung Electronics, our research, our forming the opinion, was way before the Galaxy 7 problem broke, and our going public was after the first recall, but before killing the product.
Right.
And it's one of these idiosyncratic things that happen. We think, and we have said publicly, that Samsung is a tremendously adept company. Our confidence in their basic value and their ability to solve their problems, of which this is not a small problem, but we have expressed confidence, and we have expressed that this situation does not shake or shatter our belief that there's a potentially very, very value accretive overall solution to these other things that transcend this singular problem. So,
and you say your conversations with them so far have been constructive? You think they accept your criticisms on capital structure?
I don't
believe.
Sorry.
But sorry, I'm sorry. Go on. Yeah.
I believe we have not had direct conversations with them, but the public back and forth has been, and I wouldn't be able to talk about it, but I do believe there haven't been direct conversations yet.
Okay. But they don't they haven't rejected outright your critique, your diagnosis, whether of the capital structure or the board membership. You're suggesting that there's been some constructive public response, at least.
Right, among other reasons, I believe, not just the tone and the thoroughness of our research, but as I said, these things are things that many people feel have been in the works, should be done, maybe are being contemplated, but maybe not in the time frame that we're suggesting. So we're optimistic about that one. We think it's a tremendous platform with tremendous value.
Thank you.
We have one more thing
please.
about that one.
Yeah.
A listing. There's only a Korean listing at this point, and we thought one of the elements that we asked for is a U.S. listing. We mentioned the Nasdaq. It could be the Nasdaq, possibly the NYC.
And again, their public response suggests they may be open to that?
I don't believe that they have responded to that element.
We have time for one question. Yes, sir, there at the back. Please wait for the microphone, which is going to migrate towards you gradually. I think maybe behind you, actually. Yeah, got to get there quicker.
Okay. Hi.
Thank you.
Adam Gold. Would you start Elliott today with 1.3 million, given the markets and the size and scale of how important it is? Is it possible to do that today?
Of course it's possible. And there are people starting tiny little friends and family hedge funds, as Elliott was at the beginning. There are challenges now to achieving scale. Anybody starting now, when I started with 1.3 million, I was primitive, all by myself, in a primitive set of markets. Convertible bonds, 25 and 50 bonds, meaning $25,000 or $50,000, was a good trade. $100,000 was a big trade. Markets have grown, capital in the hedge fund industry has grown. And so I wouldn't discourage anyone with a good idea from starting a private investment firm with a very small amount of money and a great idea.
But all the evidence is that passive investing these days seems to be rather more successful than, I want to say activist investing, than certainly active investing. Is that going to just, are we headed to a world in which the vast bulk of investment funds are going to be just placed in indexed funds?
Well, it's easy to extrapolate, and to extrapolate today's trends in ETFs and index funds with an increasing proportion of capital devoted to passive strategies would lead you to think that. But it's a double-edged sword. And we believe in a balance of power, and we also believe that as one edge of that sword is that there's a fallacy of composition. Indexing or passive strategies, cutting the fees to zero or close to zero, has some merit. It has some theoretical merit, practical merit, because people, studies have shown that it's hard to outperform the markets in plain vanilla securities. In fact, it's hard to outperform the markets, period. But the lower the proportion of capital that's managed by people who are actually doing the work, who are trying to figure things out, ultimately, the greater the disparities possibly between value and price. And so there is more opportunity for those who actually are paying attention or are doing the work or who have an ability not to be benchmarked and do their thing to create value or bring securities by active strategies of different kinds toward value. Now, in the sphere of activism, as I say, I believe in a balance of power. There's a whole industry of people to protect corporations, an industry devoted to saying that long-termism is a valuable moral thing and short-termism is bad. Bad people, bad strategies, bad short-term. The fact of the matter is, and I can't speak for any other activist firm, but the fact of the matter is that Elliott's holding period for activist positions is just shy of 2 years. The average institutional equity ownership, equity holding period, 1.5 years. So this struggle, because it is, between managements, some of whom can sit for 10, 20 years or more with losing strategies, either destroying value or not creating value, and then an activist can come in. And there are activist strategies that are destructive and harmful and short-termist in a way that harms every constituency but theirs. But we think that the things we've done have added to stakeholder value broadly, certainly shareholder value, and we think that the balance of power is harmed by passive investing, but it opens up more opportunities.
Thank you, Paul. Well, I'm afraid our investment horizon is 25 minutes, so we are done. But please, ladies and gentlemen, thank you very much. Thanks, thank Paul Singer.